Hello, good morning, and a very warm welcome to this webinar on risk assessment in audit planning. My apologies for a bit of a delay in setting up our system. The webinar system in Islamabad office, unfortunately, was not feeling well. It crashed, and we had to, depend on our standby system. But anyways, we are now in a position to run the webinar. I welcome all of you, and there's a very big number of members who are attending the webinar right now. So Khurram, if I can share the number with you, there are about 290 or about 300 participants who are already attending this session. They're already there. So I think that sort of indicates it's a very, very popular subject, and because a lot of ACCA members, I know they're working in the domain of internal audit. So a brief introduction of our trainer today, and after which I will hand over formally to Khurram. Very quickly, Khurram Adil is an ACCA member. He has over 13 years of auditing experience in financial services sector, primarily in banking, internal controls, over financial reporting, implementation of ISO standards, information systems, information technology auditing, and currently Khurram is the head of internal audit at Mobilink Microfinance Bank. At the same time, Khurram also is a member of our corporate governance for banking subcommittee, and he plays an active role there. A senior member, I think, very well experienced also. I think it'll be an excellent opportunity for all of you to learn from his experience and expertise. So with that, without any further ado, I will hand over to Khurram. Just a few housekeeping announcements. Number one, we've lost about 20 minutes of the webinar. So the webinar will run over by 20 minutes. We will give it exactly 2 hours. And number two, there will be question and answer breaks. So after exactly 1 hour, there's going to be a question and answer break. And I will in fact request Khurram that once he's completed explaining one concept, he could take a question and answer break in the middle as well, which would mean there will be adequate opportunities for the participants to ask their questions, if any. But at the same time, Khurram is also going to continue to ask you questions. Now, I've noticed that some of the participants are saying that they cannot unmute themselves, but this is how the webinar works. If you have to ask a question, please type in your question in the questions dialog box. And I am sitting here and my colleague Carol is sitting here, and we are reading all the questions. And when it comes to the question and answer break, we will, put all your questions up to Khurram. So that's the way. If Khurram asks you a question or asks for a comment from you, once again, you can go back to your questions dialog box and type it in there. So that was basic housekeeping. Your microphones are going to remain muted. The only unmuted microphone in the webinar is going to be Khurram's own microphone. I will probably jump in only when there is a question answer break. Very quickly, I know there are a lot of people who ask for the recording of the webinar and about the presentation. I am going to upload the presentation in the handouts very soon, but then the presentation will also be available to all the participants after the session. Okay, and similarly, the video recording of this session, the session is being video recorded right now. So the recording will be available to you right after the session is over. Okay, and if you want to revisit the content, you can conveniently go back and have a look at it. So that's all from my side. I wish all of you a very, very interactive and a good, knowledgeable session. So I think with that, I'll hand over to Khurram. Khurram, over to you.
Thank you, Harun, for my brief introduction. Welcome you all Thank you very much for joining this session in the huge number, and that's what indicating the importance of audit risk assessment and audit planning. Risk assessment has become very famous, a kind of very you can say very important in the field of internal auditing. There are two reasons. One, that the Institute of Internal Auditors, IPPF, International Professional Practice Framework, requires to conduct risk assessment in any internal audit activity, either that activity is working within the manufacturing, within financial service, within service industry, and anything. Whereas in the most recently, for the banking industry of Pakistan, State Bank of Pakistan has issued latest guidelines about the internal audit activity, and which has also mandated to conduct risk assessment. So this aspect has become very important and gained very high criticality within the audit planning and internal audit activity. So let's move forward to learning objective of today's session. First, I will start with a background introduction, then I'll move on to understanding the very concept of risk-based audit planning. And then there is a bit advanced stage of identifying and categorizing audit universe for risk-based planning. Although identifying audit universe is very interesting area to learn and area to work with. And then we'll move forward to identifying risk and assessing impact and the probability. That will be carried with the example of risk assessment criteria for impact. And then we'll move on to building risk-based strategic and annual plans, which is again the evolutionary part or the final part of risk assessment. The core purpose of risk assessment is to identify and to plan and to create strategic plans and annual plans. And then finally, we'll look into it how to write and update strategic and annual audit plans. So I'll keep you asking questions relevant to your fields, and I personally believe that this session will be very helpful for all the colleagues who are working in financial industry, because the fact of the matter is that SPP has put quite stringent deadlines to conduct these things within the financial industry. But overall, it is very important for other internal audit activities who are working in other sectors. If they want to be complied with IPPF, they have to conduct risk assessment, and they have to understand the core principles of how risk assessment is being conducted. So, internal auditing is the independent, objective evaluation of organizations' internal controls to effectively manage risks within its risk appetite. That is a very broad, basic definition of internal auditing. So, the core about is managing risks within the risk appetite of the organization. So we have to understand what is the risk appetite. A risk appetite is the overall capability or the ability of the organization to take exposure on risks or the opportunities. And internal auditing, you have to manage, you have to guard the overall operations or the strategic planning of the organization, to keep guard that their activities are within the risk appetite of the organization. Although management of risk is an essential part of good corporate governance, but over the last few years, the need to manage risks has become recognized as an essential part of good corporate governance practice. This has put organizations under increasing pressure to identify all the business risks they face and to explain how they manage them. this is a critical part, to explain how they manage them. This is where internal auditing practices come into play. In fact, the activities involved in managing risks have been recognized as playing a central and essential role in maintaining a sound system of internal controls. So another objective of internal auditing activity is to evaluate the organization's internal controls. So you can correlate here. There are definitely increasing pressure on businesses to identify all the business risks and to explain how they manage them. So I have a question to all the audience is that what are the business risks that organizations face in today's market infrastructure? So increasing pressure on businesses to identify all the business risks and to explain how they manage them. While the responsibility, as we all have read and understood, that the responsibility for identifying and managing risks belongs to management, of course. But one of the key roles of internal audit is to provide assurance that those risks have been properly managed. Key role of internal audit is to provide assurance that those risks have been properly managed. Therefore, it is believed that the professional internal audit activity can best achieve its mission as a cornerstone of governance by positioning its work in the context of the organization's own risk management framework. So I have a question that what if the organization have their own risk management framework, what the internal audit should do with the enterprise risk management framework of the organization? Is the internal audit required to conduct their own risk assessment if the enterprise risk management is there? So that's a question. Think about it and reply with your written answers. I repeat my question, that what if the organization have already established enterprise risk management, still the internal audit activity required to conduct its risk assessment to plan its annual audit plans?
We are starting to get answers. Sanaullah said yes, and Shoaib Ahmed said yes, internal audit has to perform risk assessment. Sanaullah continues by saying because internal audit should be seen to be objective and independent apart from management activities. Mirza Faizan Hussain Kazalbash is saying yes, because internal audit is an independent function. Rashid Ali is saying yes, they are required to conduct. Saqib Ali Rashidi is saying yes, an internal audit department should independently plan and assess its own risk assessment. So saying yes, Nadeem, yes, internal audit have a different role. Munazza, to check controls are strong, and a number of other comments. I'll just read out one more. It's a detailed one by Hamza Saeed Ahmed saying internal audit have to make sure that the framework and risk management prepared by the management is up to the mark and compared with internal auditors' findings.
That's great. I'm happy that there is a broad understanding of independence of internal audit activity, and that's excellent, very good knowledge on part of the participants. So moving forward, Objective of risk-based planning is to ensure that the auditor examines subjects carrying highest risk to the achievement of the organization's objective. Risk-based audit planning provides for a systematic approach to internal audit work through acquiring knowledge of the wide range of issues related to risk assessment and internal control environment. So the main challenge faced by majority of internal auditors is how to allocate limited internal audit resources in the most effective way. As you all are practicing internal auditors, you can well understand that organizations do not like to invest with the internal audit department of the organization, because they are being treated as being considered as cost centers. So internal auditors, they always have to have limited resources, but they have to cover a lot of work. So how to choose the audit subjects to examine? That's a big question. How to choose the audit subjects to examine? We cannot take a lot of work. We cannot capture the entire organization for a 1 year, for a 2-year plan. This is out of possibilities. So the core question is how to choose, how to come to the conclusion that audit subjects are required to be examined. What qualities those audit subjects should have. So this requires an assessment of risk factors across all the auditable areas that auditors might examine. Definitely, strategic and annual audit plans must be developed through a process that identifies and prioritizes potential audit topics. So I put up a little comparison of traditional internal audit planning and risk-based internal audit approach. In a traditional audit planning, audit plan is based on the audit cycle. That is a typical cyclic methodology. Like every year you have to do certain audit assignments, but there is no value addition, just a cyclic approach. Whereas audit plan, in the risk-based internal audit approach, audit plan is based on the results of the business risk evaluation. Risky areas are covered first and more frequently. So this makes more sense. It's more objectivity in it. So in a traditional approach, important risks might not be covered during the audit plan. Obviously, we are doing a very cyclic, very robotic type of audit. So there is a possibility that high risk, important risks might not be covered. Whereas in risk-based audit approach, it provides assurance that important risks are being managed properly, because we are approaching our audit work through a proper assessment of risks. Again, traditional audit approach focuses on deficiencies in controls and cases of non-compliance with policies and procedures. This is a very typical methodology within the internal audit, and it's kind of a stigma in internal auditors that they do not value add. Rather, they just go for the deficiencies of internal controls and they look for non-compliances within the auditable area. In order to remove this and in order to really add value to the organization, again, risk-based approach is the best approach, where we focuses on more on risks, not properly controlled or overly controlled. So with that, the internal audit activity becomes more objective to the organization. In traditional audit approach, we cannot really properly and effectively allocate resources to all the business activities, whereas we can identify, as we have already spoken, that more efficient allocation of resources is possible through risk assessment prior to conducting any audits. Again, in traditional audit approach, the business risks are out of question to be mapped with, because there is no risk assessment being conducted prior to planning of any assignment or creating any annual audit plans. Whereas the importance of risk is established during the risk assessment phase is in agreement between internal audit and the management. There are definitely a number of disagreements with the business management over the action plans, leading to delays in implementation of audit recommendations. Whereas the risk-based audit plan facilitates the management in consensus with the line management on the needed action plans, thus improving timely implementation of corrective measures. Strategic and annual audit plans must be developed through a process that identifies and prioritizes potential audit topics. The entire population of potential auditable areas, which can be categorized in many ways, is called the audit universe. So risk assessment starts with the identification and the categorization of audit universe. I will cover that in the later part. For each element of the audit universe, the risks and the opportunities have to be assessed and decisions taken on other risk factors that may influence the priority to be given to each element of the audit universe. The strategic and annual audit plans are very important documents within the internal audit activity of any organization, which are normally prepared and presented to board audit committee for approval and for management and with management for implementation. The strategic plan provides an opportunity to present the work of internal auditor and benefits that will arise from the audit function. The strategic audit plan, it is multi-year audit plan, again if developed on the risk-based methodology, then it will definitely derive value to the organization and the management. It will help to gain trust of the management as well. Actually, the strategic audit plan represents a shop window which explains what internal audit can do for the management over a number of years. The annual plan translates the strategic plan into the audit assignments to be carried out in a current year or in any year. So the strategic plan is further defined into annual audit plans, further translated into annual audit plans. The strategic and annual plans must be clearly structured and well written and should provide management with the persuasive summary of the logic supporting the judgments made on the priority given to certain topics. Again, I would definitely talk about a structured approach to risk-based planning. We'll discuss a structured approach in our later part of the presentation. A structured approach in risk-based planning is an important step towards an effective audit strategy. So let's have some insight about what Institute of Internal Audit says and recommends about risk assessment within the internal audit activity. The Institute of Internal Audit in International Standards for the Professional Practice of Internal Auditing on planning internal audit work requires to develop risk-based audit plan. The standards I briefly referred here is standard 2010, where it states that the chief audit executive must establish risk-based plans to determine the priorities of the internal audit. Again, there is an implementation standard, IEA implementation standard 2010A1. The internal audit activity plans of engagement must be based on a documented risk assessment undertaken at least annually. The impact of senior management, the input of senior management, and the board must be considered in this process. So, the standard also requires onboarding all of the stakeholders within the risk assessment process of internal audit activity. The chief audit executive should take into account the organization's risk management framework, including the risk appetite level set by the management, because internal audit activity do not set risk appetite for an organization. It's a management activity. Management decides what should be our risk appetite. However, the internal audit activity has to gauge the operations of the organization, that they are working within the risk appetite of that organization. So if risk management framework does not exist, so here comes the situation that I have asked questions that what if the organization's enterprise risk management exists within the organization? Then obviously all the participants have replied very well that even then internal audit activity has to conduct independent risk assessment of the organization. What if there is no ERM exist in the organization? Then what the chief internal auditor should do, so if a risk management framework does not exist within the organization, the chief audit executive must use his own judgment of risks after consideration of input from senior management. So even then, head internal audit cannot take decisions or make judgments independently of the management if the ERM is not exist there. Even then, CAE is required to consider the input, required to take input from the management and the relevant subcommittees of the board. So HIA, the head internal audit, must review and adjust the plan as necessary. So this is very practical step, and it is often found to be carried with number of difficulties, because management generally do not positively reply to feedbacks of internal audit, and they have to make their own judgments in response to changes to the organization's business, risks, operations, programs, systems, and controls. I will read out another implementation standard of IAA, that is 2010A2, which states that the chief audit executive must identify and consider the expectations of senior management. So in context of risk management framework within the organization is non-existent, then this requires that even then the chief audit executive must identify and consider the expectations of senior management, the board, and other stakeholders for internal audit opinions and other conclusions. So it comes out as a conclusion that internal audit activity, even when the risk management framework is non-existent, it cannot work in isolation and make their own subjective judgments of the business risk, operations, programs. Even then, they have to take the take input from the senior management and the board, and to map their expectation with the work of internal audit activity. Another standard, IA standard 2020, which states that the chief audit executive must communicate the internal audit activities plan and resource requirement. Now, this is very operational management, and this standard really goes on to the operational level of internal audit activity, that it requires to share resource requirement, including significant interim changes to senior management and the board for review and their approval. The chief audit executive must also communicate the impact of resource limitation. This is very important, and generally this particular piece of the information is not being exercised within the internal audit activities. I have seen in number of scenarios where limitation on a resource is not being shared or is not being advocated very loudly with the columns of management, because it is being taken as negative, that if the resource within the internal audit activity is being fueled further, they will have more observations against the management. So the standards requires that, and in order to comply with the standards, we must have to establish certain frameworks, certain mechanism where we can give our satisfaction to board that we have enough resources, or we have limited resources, or we have out of proportional resources with the amount of work that we are required to conduct within a year. So I will interpret these standards that, just to make it more clear, that the Chief Audit Executive is responsible for developing a risk-based plan. The Chief Audit Executive takes into account the organization's risk management, including using risk appetite levels set by management for different activities are part of the organization. If a framework does not exist, even then the Chief Audit Executive has to consider the input from the management and the board. So this is about IBPF, the standards, IAA standards that requires to be complied with. So moving forward to the main area of understanding risk-based audit planning. So we'll start with what is risk. Risk is the possibility that an event will occur and adversely affect the achievement of objectives of an organization. And obviously risk is measured in terms of impact and likelihood. But risk, there are further other key definitions within the sphere of risk that we have to look into. Event and threat or vulnerability. What is event? What is threat? And what is vulnerability? And the spectrum of risk, what is opportunity? Inherent risk, obviously we understand it very well. What is inherent risk? What is residual risk? Risk appetite, we have already spoken about it. And risk factors, we'll talk about it later. But how can you define opportunity within the spectrum of risk? Any suggestions, any feedback, I would welcome that. While we are defining risk as it will adversely affect the achievement of objectives, how we are correlating adverse effects with the opportunity? Harun, are you receiving any responses?
Yes, people have started typing. So Sadakat Hussain is saying opportunity of being the best one. Sanawla is saying opportunity is any event that may prove to be fruitful to the organization. And there are more responses coming, I believe.
That's great. So when we talk about risks, we always take it with a negative frame of mind that risk will adversely affect. But in the exploration, in the journey of exploring risk within the organization, we also find opportunities where we can capitalize in the benefit of the organization. So I'll define key definitions one by one. Event, a threat, as the name suggests, an incident or occurrence from sources internal or external to the organization, which may affect the achievement of objectives. Events can be negative impact, positive impact, or both. Events with negative impact represent risks, and events with positive impact represent opportunities. Opportunity is the possibility that an event will occur and positively affect the achievement of objectives of the organization. So this is very interesting. We should not have a unifocal approach to risk assessment. We should have bifocal approach. We should also explore opportunities, and we generally miss out all those opportunities where we can capitalize during the process of risk assessment for internal auditing. So inherent risk is the level of risk before any mitigation actions such as control activities have been taken into account. Example, the inherent risk of flooding before taking into account flood prevention measures. This is just an example that the flood will come and we have not taken any mitigation action to prevent the effects of flooding. This is our inherent risk, that the flood will come. So the residual risk is the level of risk after taking it into account risk mitigation actions such as control activities. The auditors must concerned with the level of residual risk. This is the most critical area in the risk assessment, residual risk. The entire risk assessment. Today we are going to have a concept of risk assessment on the basis of residual risk of the organization. There are other approaches which take into account only inherent risk, and they conduct risk assessment and they identify the auditable activities for next 1 or 2 years based on the inherent risks carried on the processes or the assets of the organization. So I'll get into residual risk where you account for all the activities of all the controlling activities of the organization. To my viewpoint, it is more objective, where you take into account the existing control structure of the organization, and then you identify the residual risks. Well, there are certain cases where inherent and residual risk will be same. Obviously, when there are no mitigation activities applied by the management, the inherent risk will be equal to the residual risk. But there are certain controls that usually have lower level of residual risks. Once the management has established a robust system of internal controls, the residual risk will definitely be lower. And the lower residual risk will translate into lesser amount of activities that internal audit will have to conduct in coming years. Risk appetite is the level of risk that an organization is willing to accept in pursuit of its objectives. Risk appetite is defined by the management. However, it has to be approved by the board. This one point the organizations are missing on, that the board should be made aware of the risk appetite level of an organization. Management in itself cannot define and establish risk appetite. They just have to recommend that this much the level of risk we are going to accept in the pursuit of our objectives, but particular piece must be approved by the board. What are the risk factors? These are generic terms used to describe factors that can indicate a higher level of risk and are priority to be given to one element of audit universe. Now we are going to talk about what is risk management and what is risk assessment and the possible overlap between the two aspects of risks. There is seen to be a significant overlap between two stages of risk management and the second and third stage of audit planning of risk assessment. We'll talk about each one in detail here. Risk management stages are defined by these are recommended stages through the ISO 31001. I hope you people are aware about risk assessment standard ISO 31001, which governs the establishment of risk management within the organization. Whereas we are going to map the risk management stages with the risk-based audit planning stages. In general, risk management stages include identifying events that may give rise to risks and opportunities. So identification is the first step. Identification of events is the first step that provide risks and opportunities to the achievement of objectives. However, in the risk-based audit planning stages, determining and categorizing the audit universe is the first stage. As we all know that risk management is the responsibility of management, they have to start with identifying the events, whereas risk-based audit planning stage starts from determining and categorizing the audit universe. Now, where the audit universe will come from? It will come from the management's work on identification of events. How management is going to identify events? They have to have a complete repository of processes or the assets of the organization where they have to protect and identify risks. So this is the first starting point to determine and categorize audit universe. And then the management will have to score events in terms of probability and impact to identify the level of inherent risks. Scoring events in terms of probability and impact to identify the level of inherent risk will again lay a foundation for internal audit activity to do its second stage. And the second stage is identifying events that may give rise to risk and opportunities across the audit universe. This is essentially the same process, but is related to audit universe, not related to the entire organization or not necessarily related to the management. They have done that. The internal auditor will be very interested to know how management have assessed inherent risk. So this is very critical. The internal audit have to understand how management has assessed inherent risks. But the main concern for planning purpose is residual risk. Again, this is my opinion that I conduct risk-based audit planning on the residual risk. So this review must take into account steps 3 and 4 of the risk management. Auditors are not responsible for putting into place mitigation actions. It is the management that has to install or to establish system of internal controls and any mitigation action. They have to conduct any mitigation action or implement any mitigative activities to minimize the risks. However, internal audit must assess the effectiveness of control activities in terms of its impact on residual risk. So this is very critical point. This is very critical part. The main difference is that managers need to assess inherent risks so that they can determine and put in place the mitigation action, including the controls. The auditors, however, need to assess residual risk. I will share a simple example here. Example of relationship between inherent risk, control activities, and residual risk. If you cross the street, there are nearly infinite number of inherent risks. One of the inherent risks with a high probability and large impact would be getting hit by a car. So to mitigate this risk, we implement the control of looking left and right to check for oncoming traffic before crossing the road. but this will not eliminate every possible risk, and residual risk remain. For example, you could still be hit by a meteor because you did not look up. So we cannot really make zero or minimize to the level of zero any residual risk. Residual risk will remain. And that is why I give importance to residual risk in planning of annual audit plans or the audit strategy for coming years. So talking about third point of risk management strategies, it is about determine an appropriate risk response. So the second stage was to identification of impact, and this third stage is how management is going to react in response to those identified risks. So in order to avoid or to transfer the risk, or whatever the mitigation strategy management is going to adopt. But risk-based audit planning, the stage 3 requires to scoring events in terms of probability and impact, obviously taking into account management action to mitigate risk, to identify the level of residual risks. This is the stage where internal audit activity establishes the probability and impact of all the risks, taking into account all the controlling activities that management is doing. The fourth stage for risk management is putting in place the risk mitigation action decided upon to arrive at any acceptable level of residual risk. That this is where we have to consider the concept of risk appetite. The management, how much management is going to accept residual risk should not be greater than the risk appetite set by the board for the organization. The residual risk should always be less than or equal to risk appetite of the organization. So for internal auditors, this stage requires a generic risk developing a generic risk factors and criteria for each factors to identify the audit priority of audit objects within the audit universe. This is where the priority of auditable units comes from. You get a scoring. We'll work through the example in a later part. You get through the scoring of all the residual risk, and then prioritize your activities according to your audit universe. And then finally, it is about developing and maintaining risk-based audit plan. It may be some organizations require strategic audit plan. Strategic audit plan is multi-year audit plan and annual audit work. So understanding the difference between inherent and residual risk, we have already spoken very well, quite in length, about the difference between inherent and the residual risk. So in the risk assessment, risk-based audit planning, or the identification of risks prior to conduct any audit assignments, the core focus of auditors in risk-based planning is on identifying high level of residual risks. In practice, sometimes it is very difficult to agree the management that you have X amount of residual risk on certain process. However, management has a different opinion that they have Y amount of residual risk on that particular process. So this disagreement should be discussed, should be deliberated with the management, and the internal auditor should try to align its assessment according to a legible argument that management is presenting to you. And while considering, internal audit is again required to take into account the core business of the organization, the core risks that the organization is facing. And if the organization is new or there is very less information about the effectiveness of control activities, then the situation is that inherent risk is equal to residual risk. So what is the conceptual framework of risk-based audit plan? The conceptual framework guides us to determining and categorizing audit universe, number one. And number two, identifying individual events that may give rise to risk and opportunities across the audit universe. Scoring events in terms of probability and impact. Building risk-based audit plans by using generic risk factors. And then presenting the results of risk-based audit planning by writing and updating strategic and annual work plans. So we'll talk about audit universe. How have you, first of all, the first question is, have you developed audit universe in your own domains or in your organizations? This is a starting point for risk-based audit planning for internal audit activity. And if that is not properly maintained, the entire activity could go to a wrong direction. So scoring events is, again, we practically do that, how we are going to score various events and events in terms of their probability and impact. So moving forward, I have tried to put in place, this is very thickly populated presentation. I'm sorry for that, because I cannot really keep in mind all the points, but it will help you once you have this presentation. It will give you a brief idea what to do when there is a risk management in place and when there is no risk management in place in an organization. So key actions required to implement the conceptual framework for risk-based planning and how this would differ for organization with or without risk management system is in place. So on the left hand side, I have put in place all the risk-based audit plan stages that we have just discussed in our previous slides. So what to do and what not to expect when risk management is not in place. Determining and categorizing the audit universe. When risk management is in place, identify categories for splitting the audit universe into discrete auditable objects. So this is very critical. Audit universe must be translated into discrete auditable objects, which can be separately, uniquely identifiable units where they have their specific scope for internal audit to conduct the internal audit activity. We have to go to the management and discuss and agree approach to categorization of audit universe with management, and then finally identify and list all the audit objects in your audit universe by agreed category. Well, identifying events that may give rise to risk and opportunities across the audit universe. It is best recommended that you must take into account the risk registers that management or the risk management department of any organization is maintaining to understand the events that managers have identified, managers of risks have identified. So this is the first point where the internal audit activity can fast learn from understanding or taking into account the risk registers that risk management department is maintaining. So risk register is the repository of all the risks against any activity, process, or asset. So this can really fast learn us and will make us capable or able to identify the audit universe for internal audit activity. Consider completeness of events identified and discuss with management their views on the organization's risk appetite. Completeness of events, what does it mean by completeness of events? And why it is required to discuss with management? Any ideas? This is another very critical element or the point which generally is missed out in our daily practices.
No comments so far.
Okay. The internal audit activity has to gauge the completeness of events through applying their own independent judgment. There is a high possibility that the management must have skipped certain events on a certain process, which now internal audit activity is having eye on that. And this is a particular area where you can reach to the management and tell them that this particular event is missed out and I have a different perspective on it, and which might result the breach of the organization's risk appetite. So this is a two-way traffic to the management, and you can make realize the management that this is one of the benefit of risk assessment conducted by internal audit activity. So this is how you can check the completeness of events. And when there is no risk management in place, definitely the internal audit activity is at its own. But you cannot really escape the management's opinion. You have to take into account. So what specifically is required? It is required to identify events that may give rise to risks and opportunities across the audit universe. Remember, in the risk management, when the risk management place, we are referring to risk register that risk management is maintaining and developing. Whereas when no risk management is in place, we have to identify events. Well, you can ask questions that we are not expert of identifying events that may give rise to risks. Although we have different capacity, we have different viewpoint, we have a habit of being skeptic about certain processes of the organization's ability to achieve objectives, but we are not expert in risk management processes. So there must be a gap left in identifying audit universe. But as you know that the risk management is the responsibility of the management, you cannot really discharge our responsibility, and we have to apply best of our professional skepticism and professional judgment in identifying events that may give rise to risks and opportunities across the audit universe. Once we have identified these events, we have to discuss these risks and opportunities with the management to obtain their views. Their view is very important on completeness and discuss with management their views on the organization's risk appetite. Thirdly, when we are going to score events in terms of probability and impact, taking into account management actions to mitigate risks, to identify the level of residual risks. What we are required to do when the risk management is in place, we have to review the way that the management has scored events and the actions accurately and to all the key risks. This is where our independent evaluation or the judgment comes into play. We have to have a very skeptic view how management is scoring the events and actions. We have to consider effectiveness of risk mitigation actions. Any action that is in place, it is visible, it is required to be reviewed. You can discuss with management, and you can take confidence of management, and you can judge the confidence of management that how effective that mitigation action plan is, so that you can also independently rate the mitigation action, so that you can have a valid, legible residual risk based on which you are going to plan your annual audit activity. You have to also check and identify high levels of residual risk that need to be factored into strategic and annual work plans. When there is no risk management in place, again, the subjectivity will be more when the formal risk management infrastructure is not within the organization. But even then, it is always best to conduct risk-based audit plan rather than going on a cyclic and non-risk-based audit planning. This is waste of resources, waste of energies for the internal audit activity. What we have to do, we have to score events in terms of probability and impact, taking into account management actions to mitigate risks and to identify the level of residual risks. And once again, we have to discuss with managers. On every step, you cannot really leave management in taking actions for your internal audit activity or audit plan. Management has to be part and parcel of every step. Why? Because internal audit activity has to bridge that expectation gap or the capability gap between the management and internal audit. They should work, they must be treated, they must be considered as trusted advisor rather than the policeman of the organization. So it is always very critical to have politically balanced relationship with the management. But in the same line, you also need to be able to conduct your evaluation of the organization's internal controls independently. So the political relationship should not really influence your independence. Well, on the fourth stage, when you are going to develop generic risk factors and criteria for each risk factors to identify the audit priority of audit objects within the audit universe, our actions will be indifferent. Either that risk management is in place or risk management is not in place. We have to produce initial list of risk factors. We have to determine criteria for scoring each risk factor. This is what we are going to do in the later part. And to decide whether to add a weightage to each risk factor. These things will get more clear once we'll work through the example. And discuss the approach with management and obtain their views on the relevance of the risk factors that internal audit has chosen, and the criteria to be used in scoring and weighing to be given. Score each risk factors to identify high, medium, or low priorities for all the audit objects in the audit universe. Then finally, when the risk-based audit plan is prepared, we have to determine the strategy and cycles of coverage for different categories of audit universe based on the risk factor scores. We have to develop a strategy document that supports the choices made and explain the methodology used and judgments made to arrive at decisions. We have to develop an annual work plan in line with the strategy, identified the specific audits to be undertaken, their titles, the timings, and the expected duration. This is the final stage when we are going to produce our audit plan. So now we are touching one by one all the stages that we have worked through or gone through in our previous slides. So before moving forward, I would like to take feedback or the comments about how we can categorize our audit universe for risk-based audit plan.
Horam, we've got questions as well, so whenever you're up for questions, let me know. We can start one by one. In the
All right.
meanwhile, we're waiting for the comments.
All right. So audit universe is the starting point for the internal audit plan. The overall scope of internal audit function and the totality of the auditable processes, functions, and locations. So what are auditable objects? What is top-down and vertical approach? What is cross-functional and horizontal analysis? The auditable objects typically, the audit universe is a mix of top-down, vertical, and cross. I'll come into it, but let me explain what is auditable object. The universe consists of totality of auditable objects, which is why of identifying and describing discrete part of the business system or processes which can be separately audited. Auditable objects need to be large enough to justify an audit and small enough to be manageable. So I'll have to move a little bit quicker as seems I have a lot of other slides to cover. So what are the possible information sources for categorizing our audit universe? It is about management information giving a breakdown of goals, objectives, and targets. This is where you can get information. You can get information from the guides to the organization's services, organizational charts or office directory, the annual reports and any performance targets set for the organization, corporate and departmental plans, business plans, development plans for IT, other infrastructure, buildings. These are all tools where you can categorize your audit universe. Well, you can also seek senior managers' opinion. Senior managers must be consulted for their views on the importance of processes, systems, identified and existing controls and general control environment. Ultimately, it is for the chief audit executive to decide how to categorize the audit universe and how many slices it makes sense to use. What typically the discussion with the managers should be conducted in open manner of focus on. It's about clarifying the organization's main objectives and the role of individual departments in achieving these. Identifying the main risks they face in achieving the organization and their departmental objectives. The results of any internal or external work carried out during the year. Any areas of concern that managers may have over internal control. This is very important. Any areas of concerns that managers may have over internal controls or efficiency within their department or the organization's priorities for the assurance and audit attention. So the management will facilitate the management so that the management will be telling you that this particular area, my department's this particular area is weak, and please conduct an audit, conduct an efficiency audit on it and guide me where I can improve. So let's move quickly to identifying risks and assessing impact and probability. This is the most difficult part of risk assessment. Risk is a general term that can be difficult to grasp. However, almost everyone understands what an event is. Thinking of events that could impact objectives is the easiest route to identify risks. Having identified the audit universe of auditable objects, the next step is the process to identify specific risks. The objective for IA to obtain a thorough understanding of risks facing the organization and their potential impact and probability, so that this knowledge can be used when scoring generic risk factors to select audit objects for examination. Good practice is that risk identification and risk assessment. What is risk assessment? It is about scoring for impact and probability. Should be carried out in two phases. The reason is that first phase, which is risk identification, is very similar to brainstorming, where the objective is to capture all risks. The second phase is about applying the realistic judgments on the importance and probability of risks identified. It can be complicated to combine these two different ways of thinking about risks. However, it is helpful to carry out a joint risk assessment workshop with the management. It is very important to carry out a joint risk assessment workshop with the management, and this could also include a short training session. You can also include a short training session on risk management with the professionals, with the concerned professionals of risk management. It may also encourage management to develop their own risk management process in case if they are not having any risk management process. This is more of a repetition about what to do when the risk management enterprise risk management process is in place, and what to do when the enterprise risk management is not in place. So I have put in place a very broad and very generic set of events and threats that may generate risks. This is, again, we are sitting at a stage of developing audit universe. You can split your audit universe into number of distinct auditable areas. I have put in place very generic, and I've divided my audit universe into 6 elements. One is operational, one is IT and communication, what regulatory risks are there, what financial risks are faced by my audit universe, what personnel risks are there, and what other reputation risks. And the list can go on. You can expand it to any extent according to the complexity of your organization, or you can contract it to a bare minimum level. So once the audit universe is identified, we work on various events or threats. On the operational side, like this is now I'm going to slice my audit universe into certain domains. In the operational domain, I'll have to look at how my organization will face loss or inaccessibility to office. My key staff will become unavailable to me. My utility failures, electricity, gas, water. What I'll have to do when there is no transportation, my critical equipment, hardware failure, I lose supplies, the key materials. And this is very basic, generic, just to make a better understanding. On account of IT and communication, I can lose my connection of internet. I can my data will become unavailable to me, or it may be destroyed. Data got corrupted. Viral attacks on my key softwares, hardware failure. My vital records destroyed and cannot be accessed. On a regulatory side, my I have to oblige my contractual obligations, but I am not really obeying those obligations. Key legislations are up on the horizon, but I have not the capacity to comply with those regulations. I may attract financial penalties for non-compliance from the regulators. On the financial side, I got budget cuts, loss of grants or funding, theft of misuse of funds, lack of cash for operations. On the personal side, loss of key staff, resignation, retirement, lack of integrity of manager, lack of skills or qualifications. On the reputation side, negative media publicity, levels of service below expectation, loss of trust from the key stakeholders because of operations shortcomings. So this is just a slicing and dicing of my audit universe. And this is where assessing risks in terms of impact and probability, this is a broad, very generic heat map, and it will, once you get through it, it will guide you to help you develop your own heat map or the relationship of in terms of impact and probability. Once you have identified all relevant risks that we have just gone through in the prior slide, these risks, what I have tried to put very generic, very non-sophisticated risks, just to make everyone understand that what are the risks and what events could occur to give rise to risks. So once we have identified all the relevant risks, then there is a need to assess the risks and score them. Inherent risks should be assessed in terms of impact and probability. The impact defines the financial or non-financial consequences for the organization should the risk occur. The probability defines the chances that the risk may occur. Assessing impact of risks is more complex than assessing probability. So this is very important. Assessing the impact of risk is more complex. We cannot say with conformity that if that risk is materialized, it will give harm to X number of amount, or it will give harm to my people, or it will give harm to my operations. But once the operation is affected, we cannot quantify the impact of that risk. That is why it is more complex. Then assessing the probability. Probability is easier to assess. But both are important element of risk assessment. We can calculate our impact or consequence on number of areas. Once again, it is very open, it is very subjective, that on how many grounds you are going to calculate your impact. I have tried to put in place my 3 grounds to calculate my impact. One is my financial impact, that any risk will harm me on financially, or any risk if materialized will hurt me on my management of my people, or it will hurt my operations. But you can expand it to any extent. There is no limitation to calculate impact on various aspects. But how to score it? You can map it according to the risk appetite of the organization, or once again the criteria understood or agreed with the management. You can calculate impact. Like for example, if our risk appetite is X amount, the financial impact is less than certain amount and the impact is low, and vis-a-vis if our financial impact is just equal to our risk appetite, and we'll treat it as very high impact, high financial impact if certain risk is materialized. And definitely there is a medium range which you can set according to your own requirements or the risk culture of the organization. On the similar side, you have unplanned loss of several employees within a unit. For example, this is just an example, that there is a resource drain, unplanned resource drain within a unit, but it is not causing disruption of unit's operation. then I'll treat it as low impact. And similarly, I'll talk on the higher side that unplanned loss of several employees, but that has caused significant impact to the operation of one or more department. I have put an example of procurement or finance department. Then the impact will be high. Similarly, on the operation side, if there is limited or minimal loss to your operation, you can calculate the impact or treat the impact at the lower level. And if the organization's wide inability to continue with the normal business, slow system recovery, widespread service interruption, slow system recovery, etc., which you feel that this is going to impact on the higher side, and you can rate it on the higher side, on part of impact of your risks. While probability likelihood criteria, you can score them as if there is a low probability or the probability was made low through implementation of certain control activities. So the given if the given controls are in place, the event is expected to occur only under exceptional circumstances, and your existing controls are really capable to avoid the risks. There is very less likely that the event will occur. And similarly, if the controls are non-existent, are not effective, there is a high probability or the medium probability that the risk or the event will occur. And talking about on the scale of 5, when the event will occur on more frequent basis, which is again the higher side of that. So on the right bottom, I have calculated the risk matrix, impact and probability, which you can have a correlation of the both. As you are seeing that the likelihood, if the likelihood is low and the impact is low, the overall risk matrix is low. There is a cross-functional relationship between these two. However, as you have seen that this is a pure statistical or mathematical calculation of risk metrics, but it is also recommended not to score the risks in a pure mathematical way. It is more practical to assess and score them according to predetermined criteria for impact and probability. So this is very important in practice, that things can drastically go wrong if you score all the risks in a mathematical or statistical way, because the risks, if materialized in financial terms, you can quantify them, but rest or everything is qualitative, and qualitative aspects are not recommended to be tightly bonded in a mathematical translation. So the good practices often suggest using 3 scoring levels, but this may lead to an overscoring or the middle category. A 4-point scale may therefore be appropriate. I have put up a 5-point scale. A 4-point scale may therefore be the most appropriate, particularly for assessing impact. There is no defined rule here, and the auditors are free to choose whichever scoring system they feel is more appropriate. So for each risk impact criteria, the auditor need to define what would represent different level of impact, very high, high, medium or low. This will ensure that risks are scored in a common way. The example below provides general advice on scoring 3 criteria. So building risk-based strategic and annual plan, taking understanding from the previous framework of risk matrix, We are going to now develop a strategic plan based on the importance of risk factors. So what are the risk factors? We have just previously identified that materiality, control environment, vulnerability, sensitivity, management concerns. These are probable risk factors, and the list of these risk factors can go to any extent according to the requirements of the organization. But for the purpose of giving an example here, I have identified 4 key risk factors based on which I am going to develop or to prioritize my risk-based audit plan. So I'm going to award each of risk factors a point rating on a scale of 1 to 3 as I have explained below. Materiality: system accounts for below 35% of the annual budget. For example, you are going to conduct an audit of an activity whose system or materiality accounts below 35% of annual budget of that organization. You are going to rate it as 1. And if you are going to plan an audit of certain activity which accounts for 36 to 65% of the annual budget, or whatever the rating applicable to your organization, you can rate it as 2. And similarly, if something you are planning an audit on which accounts for more than 66% of the annual budget or any higher amount, you are going to rate it as 3. So this is a scale of rating risk factors. Similarly, you can rate control environment, vulnerability assessment. Accordingly, you can also rate on a scale of 1 to 3 sensitivity of any auditable object. Now, so far, we have identified auditable objects, we have identified audit universe, we have scored them, we have rated them accordingly, and now we are going to assess the importance of risk factors so that we can calculate and prioritize our auditable units. So the sensitivity and management concerns, for example, if something you are going to plan for upcoming audits, and the management concerns are very high about its objectives, business objectives, and they are concerned that our particular department is not going to achieve its business objectives, or there may be certain failures on it, you can accordingly rate on the scale of 1 to 3. And 3 is the higher, where system with high profile in recent past with a number of concerns of management due to recurrent failures. So you can rate it 3. Now, example of weighing risk factor is step 1. Each of the risk factor is given a weighing using judgment of the relative importance of each of the risk factors at the scale of 1 to 3. So this is the value of that particular risk factor, and this is the concern that is being defined on a scale of importance. Materiality is being rated as 3. In our particular case, the control environment is I have rated as 2 for that matter, and sensitivity of any auditable object I have categorized as 2, and then the management concerns are very high. There are recurrent failures in that particular area, so I have rated it as 3. Now, the step 2, the factor score and weightings are then combined into a formula which can be used to calculate the risk index. This risk index is going to define that I am going to conduct this audit of this particular area or not. The objective of this process is to determine what needs to be audited from within the audit universe, to identify the building blocks for the audit strategy in terms of types and cycles of audit that need to be undertaken. This is why this process is also referred to as audit need assessment. So based on this, I'm going to conduct my audit need assessments according to the risks, relevant risk factors. And there is also a possibility that there is a likely to be a high number of possible audit objects and a large number of risks. most auditors use a set of generic risk factors to review the importance of each element of audit universe to determine the priority that should be attached to each auditable object. While the term risk factor is used, these could be described as selection factors because the purpose of this stage of the process is to select the most appropriate audits to undertake. Now, selection factors or the organization's objective. This is where internal audit activity has the opportunity to align its risk-based annual audit plan with the objectives of the organization. For example, putting in place, the organization has set its objectives that for the coming year they have to increase their customer base from X number to Y number. This is the objective of the organization, and by mapping your risks with the objectives of the organization, you are going to select particular area or particular process or particular department of the management who is responsible to actually achieve that or to deliver that objective. You can rank it according to these risk factors, and you can tell management that you have set this objective and I have tried to add value through the identification, through the risk identification based on these risk factors, and I'm going to conduct audit so that I can provide you assurance that you have set an objective in a realistic manner and appropriate resources have been provided and all the audit checkpoints or the audit sessions you are going to check. So putting in place all the values like materiality, I have categorized it, remember I have categorized it as 3 on the score, risk factor score, and I have weighted in identification of my auditable objects. In particular auditor object, the materiality is 3. I have rated as 3. I have weighted as 3, and its importance are how can I explain? For example, the process under being audited, it is encompassing more than 63% of annual budget. For example, you are conducting audit of CRM, customer relationship management system of the organization, which encompassing or incurring cost of more than 63% of annual budget. My inherent risk factor rating will be 3. Whereas I have to weigh the risk factors with the value of 3, and the importance of materiality of that particular CRM system is higher, on a higher side, and I'm going to place 3. So the risk index, A into 3, B into 2, C into 2, the value that I have drawn down, and D into 3, I'm getting a value of 23. And again, this is very generic. You can redefine these metrics, you can redefine these indexes according to your own requirement. But at the stage 3, each audit's object is then categorized as high, low, medium based on a suggested risk index score. For example, risk index score, I have a relationship and above 25, I have scored as above 25. If anything comes above 25, I rate or the priority, I prioritize the audit on the higher side, and anything in between 11 to 24, I have categorized as medium, and anything below 10, I have categorized as low. And this is where internal audit activity is able to take judgment that on any given process or asset. Remember, you can repeat this formula to all the processes. You can repeat this formula to the entire of your audit universe, all the audit objects, and then you will get a certain rating based on which you can redefine your, prioritize your audit universe. And for that matter, for example, if your audit universe was constituted of, say for example, 50 processes, you are going to conduct process-based risk assessment, and you have identified 50 processes, and there are 50 processes in your audit universe, and out of those 50 you have applied this framework, and you have reached to 15 processes which were categorized or ranked at the score of above 25. And now you can reallocate your resources to those 15 processes which are categorized as high, and you can allocate more efficient resources. You can tell your board, you can tell your management that I'm going to audit these 15 processes because they are categorized as high out of the conduct of my risk assessment, and you can tell management that these are your high risk areas, and I'm going to conduct audit of only these areas rather than conducting audit of all the 50 processes, which is not possible with the limited resources. So once again, I would suggest that this is just a generic example. You can take understanding from this framework, and you can implement your own risk audit universe. You can implement this risk assessment according to your own audit universe or your own organization's requirements. It would be relatively easy to modify the system for use with a wider range of risk factors. Remember, I have used only 3-4 risk factors, but these risk factors you can increase. I have quoted that I have driven through the example of identifying risk assessment of risk assessment of processes, whereas I have seen and I have conducted risk assessments on the activity level, but that would become very extensive exercise to manage for internal audit activity with the limited resources. I have always suggested and advocated that activity level risk assessment and risk management should rest with the risk management department of the organization, rather than internal audit activity assumes this responsibility, because on an activity level all the processes are translated into tens and hundreds of activities, and rather than going on a micro level of activities, it is always recommended to confine yourself to the process or asset-based risk assessment. Asset-based risk assessment is typically useful in risk assessment of IT audits, because there are a number of assets are involved and all the processes are operational processes. That is why it is recommended to conduct IT asset-based risk assessment of IT audits. You can have a mix and match of both asset-based and process-based audit, depending upon the organizational needs and the complexity of the work that internal audit activity is going to occur. So I hope this made it clear to everybody. Harun, am I running out of time, or should we have sufficient time for question and answer?
We have about 25 minutes left.
All right. So if we have enough pool of questions, we can take time, or I can run through the remaining slide.
I think you can run through the remaining slides and then we can have questions.
All right, sure.
Okay.
So this is the final part of the entire objective of today's session. That is how effectively we are going to able to write and update strategic and annual audit plan. As we have already spoken, a comprehensive strategic and annual plan of internal audit activity is crucial to the success of internal audit. Having identified and assessed risks across the audit universe, the next step in the process is to develop a plan to address the areas of highest importance. Planning ensures a systematic approach to IE activities and requires knowledge and competence in a wide range of areas, such as risk assessment and internal controls. Well, what is the purpose of strategic plan of internal audit? It is about judgments of audit needs. What internal audit activity is going to deliver in coming year? This is the strategic plan. It should clearly express objectives of the internal audit activity within the organization. Objectives should be based on professional judgments of systems of the organization, activities of the organization, and the programs that should be subject to audit to provide reasonable assurance to management that risks and the effectiveness of internal controls are appropriate. Well, clearly expressed objectives and performance indicators for what the internal audit function will achieve in the next 2 to 4 years, linked as appropriate to the strategy for the organization. It should always be remembered that objectives of internal audit activity and the objectives of the organization are same. And they should be linked so that they both achieve their objectives in a coherent way, in a collaborative way. Well, the strategic plan should also elaborate methodology used to prepare the strategy, how the methodology used to prepare the strategy, and how the internal audit unit has assessed risks. You can write all of your approach in the methodology of risk assessment on the strategic annual audit plan. It will usually be necessary to identify cycles of coverage for different elements of the audit universe. Now, cycles of coverage, again, dependent on the risk categorization and the risk score, index score. You can identify that how frequently you are going to audit high risk elements, how frequently you are going to audit medium risk elements, and how frequently or you will ever audit low risk areas. Others may also need to be examined. For example, low risk areas, you can write it in your strategic annual audit plan that all the low risk audit activities will be audited every 3 year or 5 year or so on. Your annual audit strategy plan should cover your resource requirements and the required resources and available to meet these needs and the impact of resource constraints on the ideal level of audit coverage. So you are better in position to identify how much resource you require for the next 2 to 4 years based on this risk assessment. For example, you have identified, as we have already quoted, that out of 50 processes you have identified 15 as very critical, and you have planned to conduct audit of these 15 areas every year. Now you can very well estimate man hours, how many man hours you require to conduct audit of all these 15 areas, and you can map those man hours and gauge your existing strength and resources, and ask the management to increase or to raise your resources according to the man hours required to complete that particular piece of audits. Well, internal audit strategy plan should also cover internal risk assessment of these events which may impact the achievement of objectives in the audit strategy and mitigating actions to address such risks. For example, staffing shortfalls, skill shortages, and training and other actions need to address these risks. For example, risks are ever evolving. You cannot really statically conduct risk assessment. Risk assessment is again a very live document. For example, I happen to be in a scenario very recently where I have been asked to up my skill on blockchain. Well, within Pakistan, as we all know, we have never considered blockchain as a legitimate means, as the State Bank has also banned activities related to the blockchain. However, I've been contacted by an organization and asked that how you are going to mitigate risk on blockchain. So I have blatantly quoted that I don't have skill on how I'm going to identify risks relevant to blockchain. And this is where I have identified that I have a skill shortage. And this is where your annual or strategic audit plan should cover your possible areas of skill shortages. And this is very important. Well, how annual audit plan is translated out from a strategic annual audit plan. The annual audit plan translates the strategic plan into the audit assignments to be carried out in the current year. It should define the purpose, title, objectives, and duration of each audit assignments, and allocation of staff and other resources accordingly. The plan should provide a basis for agreeing the assignments to be undertaken and the timing of each assignment with the relevant managers, as these need to be geared to budgetary resources available. It is usually preferable for the audit plan to mirror the budgetary period. Whether these are still valid in the light of audit findings, the latest annual plan, if approved, taking consideration the main findings from previous audits that indicating changes in the risks. Remember, risk assessment is an annual activity. For example, changes in departmental organization, locations that cannot be reached in winter months, for example, major periods of leave, office closure, summer implementation of new IT systems, which going to deter or stop you from completing your annual plan. Main findings from previous audit findings: organizational and timing constraints, resources for future unplanned work. Yes, the resources that should be reserved for future unplanned works. As we all know and we understand that internal audit activity is generally mandated with unplanned activities. For example, conduct of any forensic investigation, to conduct any you can say financial embezzlement investigation of financial embezzlement. These are all unplanned. And in any annual audit plan, there should be sufficient room available for unplanned activities to avoid reshuffling of the audit plan. This is how we can keep our audit plans updated with the current requirements, keep updated with the resource requirements required to fulfill that annual audit plan, and keep them updated with the relevant and upcoming or ever evolving risks that organizations or specific industries facing. So that's all, Harun, from my side, and let's take some questions now.
Sure. I'll be very, very quick on questions, and there are quite a few that I've already marked. So let's begin one by one. Okay, here we are. This first question is from Sadakat Hussain Khan, who's saying, can you add some examples of traditional versus risk-based approach?
Okay. Sadakat, I have tried to consolidate the approach of traditional audit. I have deliberately not put in place the examples of traditional auditing just to remain within the time constraints. However, I can provide you a number of other examples of traditional cyclic audits that their annual audit activities are not based on risk assessment, rather they just identify their auditable domains. For example, I put an example of any banking institution. They have audit universe of various departments, and the audit universe further divided into the branches, and then they have their own back offices. So this is a main categorization of audit universe, and this is a typical example of traditional auditing, and they just allocate resources according to the previous audit ratings that they have conducted audit of particular department, and they decide that if, for example, I'm not quoting names of any department. If, for example, department X has a audit rating, previously audit rating, for example, good or fair, and let's skip that particular department this year, and there is a high probability that that particular department is going through or having or facing lots of risks, and internal audit has no access or assessment of those risks, objective assessment of those risks. So this is a typical example of traditional auditing where there is a high probability that relevant risks are being skipped by internal audit activity, but not conducting those risk assessment of the entire audit universe. So I hope that have answered your question without getting into or without naming a typical example. Yes, Harun?
Sorry, I was on mute. Mohammad Ahmed Khan is asking, can you please share a sample documented risk assessment mapped with audit plan?
Yes, I can share, Sadakat, but you can
No, this
contact
is
me on my
Mohammad Ahmed
email.
Khan.
Muhammad Ahmed Khan, I'm sorry. I can provide that, but it would be generic risk assessment tool.
Okay, I think if we can, even if it is generic and you can share it with us, we can put it on our Google Drive for participants to view later by themselves. Yeah.
Yeah, sure, Harun. I will share it with you later on once I reach to my office,
Okay.
and I will let you know.
Great. Sanaullah is saying IIA 2010A documented risk assessment means audit risk or only business risk.
Yeah. How you can define business risk? Business risk is all the risk that organization is facing. Sanaullah?
Sorry, if you want, I can, I mean, Sanaullah has just typed in this question, cannot be unmuted. If you want more clarity on the question, I can ask him to repeat his question.
Yeah, I need more clarity. Business risks are all the risks that organization is facing. It encompasses everything related to the organization.
Okay, next question is from Sadakat Hussain. Again, he's saying, Khurram, if you can add one or two practical examples of key definitions. So I think you've given sufficient examples, during your presentation also. Yeah. So I think that question, this question would have automatically been answered.
I can ascertain that there is a more urge of tools, practical tools, where our participants can really brush up their skills of risk assessment, and either be it on a very basic level, but I can provide that tool. Harun, I will provide you, and you can share to all the participants today, and they will be satisfied with the risk assessment.
Sure, definitely. Okay, Mohammad Ahmed Khan again, he's saying the problem here is quantifying risk impact and risk likelihood in numbers.
I'm sorry, Harun, there was some other talks within. I couldn't hear you.
Saying the problem here is quantifying risk impact and risk likelihood in numbers.
Yeah, see, I have talked about that it is not a very good idea to quantify all the risks, because the impacts are generally qualitative as well as quantitative. If the impact of a risk, if the material if the risk is materialized and impact is in financial terms, you can calculate it, you can quantify it. Whereas if the impact is on a quality side, for example, on a people side, if an employee, a key employee has resigned, or your operations are disrupted, or your reputation is at stake, you cannot quantify reputation. So it is always recommended to use best mix of quantifiable impacts and qualitative and quantitative impacts. Whereas I can share an example. Once I will share a tool, you will see that those aspects which have the qualitative aspects are also translated into some quantity. Like if you conduct risk assessment on a scale of 1 to 5, where 1 is the lowest and the 5 is the highest, or vice versa, you have some middle grounds where you can retranslate through a mathematical formula, where qualitative aspects of the impact are reasonably well defined within a quantitative aspect.
Khaja Latif is asking for a definition of audit universe.
Okay. Audit universe is the pool of all the auditable units within the organization or within the scope of internal audit activity. For example, if any activity is established within an organization, it is understood that that internal audit activity will look after to all the areas of the organization. So how all the areas of the organizations are defined? All the areas of the organizations are defined based on assets, based on processes, or mix of both. So taking example of any manufacturing concern, that manufacturing concern has sales department, that manufacturing concern has manufacturing unit, that manufacturing concern has for example customer service representative department, and X number of departments. All those departments are the constituents of the audit universe, and within those departments, all those processes that the departments conduct, all those processes are the constituents of audit universe. And you can, now this is again having a basic understanding of the audit universe, you can slice and dice of the organization. For example, you are not really willing to conduct audit of manufacturing plant this year, you can have risk assessment based on your audit universe, and you identify that this year your manufacturing plant is facing number of risks that are very that are going to impact on a higher side, and you cannot escape your responsibility to conduct audit of manufacturing unit. So I hope this have cleared the concept of audit universe. Audit universe is pool of everything within an organization, be it processes, be it departments, be it sales units, be it everything within the organization that is auditable.
Okay, thank you for this detailed explanation. Muhammad Ahmad Khan again is saying, name some companies in Pakistan where such detailed risk management stages are carried out. In internal audit, use those inherent risks to plan audit activities.
I'm not sure that in there is an organization where detailed integrated, I would rather use word integrated risk management is existing, although there are n number of organizations who are working to achieve that. Lots of investments are being put in place, but still that integrated organizational arrangement is still quite far to achieve. However, there are so many organizations within the context of our industry. For example, from where I belong in the financial industry, risk management departments are quite mature. They are working on a very high level of maturity. However, internal audit department was not thoroughly leveraging to the work of risk management department. For example, there was quite a departure, a divorce. There was lack of collaboration between these two departments or the assurance lines. For example, there is a concept of three-tier defense lines. First line of defense is the business itself. Second line of defense is all the rest of assurance lines. For example, compliance department, for example, risk department, and you can name anything. And third line of defense is the internal audit activity, who take or who provide independent assurance on the work of second line of defense and the first line of defense on an independent basis. But what I have seen, what I have experienced is there is a lack of collaboration between second line of defense and the third line of defense. But now, since specifically talking to the banking industry of Pakistan, State Bank of Pakistan has provided guidelines where it has ensured or made it mandated to work in accordance or in compliance with IPPF, and IPPF suggests that these two lines should have a close cooperation so that they can identify redundancies, they can identify duplicacies within the helm of assurance providing, because there is a high probability that management is spending so much amount on compliance department and they are doing this almost the same work that internal audit is doing. So that is why there is a dire requirement of risk control matrix. The term we use is the risk control matrix, where you map all the risks and existing controls and then identify your work in collaboration with the second line of defense and the third line of defense. And this level of maturity is kind of non-existent currently, but I hope we are going to soon achieve this, specifically with the issues of, and by the way, SPP, the credit goes to SPP that I have seen there is none other regulator who is the regulating assurance functions to such extent that SPP is currently regulating. And this is the first ever instance that SPP had issued guidelines to internal audit department of financial sector, and this has been re-quoted, reassured by many you can say media houses across the world, that this is for the first time ever the internal audit activity is being regulated by the regulator.
Okay, Khurram, there are a number of other questions, so I think we'll have to really hurry up and short answers. I think we'll have to extend the session till 1 o'clock so that we can answer some questions, and then by 1 o'clock we'll try to wrap it up. Sanaullah is asking, sir, does internal audit have to perform risk assessment at micro level, that is at each department level / activity level / function level, or at macro level?
No, Sanaullah, I categorically do not suggest that internal audit activity should conduct micro level risk assessment. Internal audit activity should conduct only process-based high level. Like, for example, if you consider or to imagine the organizational chart of the organization, the head of department -1, this is what we call C-1 activity, C-1 process. Only internal audit activity should conduct C-1 risk assessment, and that's all. Rest, it is hell lot of work, massive work to conduct risk assessment of activity levels. Thank you.
Muhammad Ahmad Khan is saying, what are the deciding factors in determining which are high residual risk and which are low residual risk? Impact on profit or quantification in numbers?
All right. Again, this is about identifying risk factors. If you identify certain risk factors that your risk appetite is going to be breached, the residue risk, even after implementation of mitigation factors, the residue risk is higher, or residue risk is touching the level of risk appetite, then you call it as a high residue risk. And on the other side, if existing system of internal control is weak and you independently judge, or you have a knowledge, you have inherent knowledge of the organization that the control environment of the organization is weak, and you can readjust the residual risk considering the existing control environment. So there are a number of factors. One is materiality, risk appetite, existing control environment. These all are elements which contribute to the definition of residual risk as high, low, or medium.
There's a question from Faiza Habib saying, are risk factors for audit planning the same as for the management? And then she continues saying, as our perspective and management's perspective can be different.
Yeah, management perspective, risk factors for the management perspective can be different because internal audit activity has a different mandate. However, the mandate of management is vast. Internal audit activity's mandate is quite limited to provide assurance on the objectives or on the objectives that organization has set, and organization is going to achieve those objectives successfully within the reasonable resources put in place. So the mandate of internal audit activity or the scope of activity, internal audit activity is limited to certain extent to provide assurance, whereas the scope of management is quite vast. So they have different contents of risk factors, and internal audit can independently determine their own risk factors. Yes, Haru. I'm really making it brief so that we can entertain other questions.
Yeah, I appreciate that. Mohammad Ahmad Khan is saying risk faced by the whole industry at large, having high impact and likelihood of occurrence, but beyond control of management. How can audit help in that?
This is where the situation where inherent risk is equal to your residual risk, and you as an internal auditor, as per the if you have been provided mandate through your charter that you have to report to board audit committee, because functionally internal audit department do not report to the management tier, they directly report to the board tier. So the internal audit in this situation, this particular situation, internal audit department should have the capacity to identify such situation, number one, and number two, should have the capacity to interpret it and interpret it to the board that management is going to accept too much risk on this particular area, which it is not mandated to. And that is what the internal audit activity is required in its entirety. You cannot jump into the shoes of management and say that this is going to blast or your residual risk is too much high.
Okay, Mirza Faizan Hussain Kazalbash is saying, can you please repeat risk index? From what is the value of A, B, C, and D derived?
Risk index.
Mirza Faizan can view the recording as well, but very briefly, he's asking about how we derive the values of A, B, and C, and D.
Okay, number one, the risk factor have their own value. For example, we have just discussed a situation where residue risk was equal to the inherent risk was equal to the residue risk. This is a situation where your materiality is touching your risk appetite, your operational risk factors are touching to the higher side, and this is the core value risk index that on particular process. For example, you are going to purchase, just give an example, name an example of you are going to purchase a car and you have the capacity to purchase car up to the cost of 1 million, but you are going to purchase a car of 1.5 million, and your residue risk and your scenario is that the organization do not have the resources to achieve the objectives from that car. So this is where your materiality comes into play, and as per the risk index, this materiality has the highest value on the scale of 1 and 3. Whereas purchase of car as a process when you are going to audit the department or particular process that particular department has purchased a car beyond its capacity, beyond its capability, that process will have the value which I am quoting it as, let me get back to the I'm quoting it as the risk weightage of that particular process. So this is where these two will be multiplied to give you a risk index. I hope that would have answered. You can further share my slide, or else you can also reach up to me and I can explain it in person whenever it is required. I'm available.
Yes, the next question is from Shahirul Hassan, saying, can you guide on how to establish, implement internal control framework in an organization? It's a very broad-based question.
Very,
So,
very broad-based.
Shahir would like to probably simplify the question. Otherwise, you probably have to run the entire session once again. So, Almas was saying, Shahid will wait for a briefer question from you. It's very generic. We move on to the next one. Almas Hussain Ali is saying, you mentioned that heat map / risk scoring, if determined at activity level, will be very extensive. Can you please clarify, because there are multiple activities and related risks in each department or process, and determining just one heat map / score for the whole process will not serve the purpose.
Yeah, fine. I would try to be very brief on this. Once again, it is very the question mandating a very detailed answer, but just give an example, because this is a very practical concept of risk assessment, and we cannot really understand every aspect of this entire concept without going through the practical real hand experience on the tools or things like that. We can understand it conceptually, but okay, coming back to the question, all the activities, all the processes are further defined or constituted by the activities. One process can have n number of activities. That n number of activities are combined to conduct or to implement that particular process. For example, I give an example of cash deposit in a financial industry. This is just one process, but it has number of other activities. For example, customer will fill a cash deposit slip. It will go to the cash counter itself. The cashier will accept, will monitor, will gauge, and will conduct due diligence on it that the particular person is legitimate. He has rightful blah blah xyz. These are all activities you can translate it to n number of down the line. However, internal audit cannot really go to each activity and conduct risk assessment, and how you are going to then manage the risk index of each activity. So it is always recommended, and the standard itself recommends, that the risk assessment should be higher level risk assessment only. However, you can leverage the knowledge, the understanding, if you are lucky enough that your organization has ERM who already doing this, because ERM is mandated to conduct activity-based risk assessment. You can get their knowledge, you can get the knowledge that this particular activity, how many a particular activity has, so that you can have a particular process. But answering your question, you better develop your audit programs on an activity-based audit programs rather than conducting risk assessment. This is my answer. A very robust, very confined, very well-defined audit program will complement your activity-based risk assessment. Yes, Harun.
Okay. Hamza Said is asking, can you please explain the difference between systematic, unsystematic, and business risk?
Okay. Systematic risks are those risks that systematically corrupt or make the organization in a situation that they are not going to achieve their own objectives. Systematic risks is a very complicated array of risks which are interlinked to many number of risks which are difficult to identify. That is why the standard says that you have to have a very good understanding of interoperability of the other risks. Risks are not isolated, risks are connected. This is a systematic approach, systematic risk. I'm sorry, I have just forgotten what was the other definition you required.
Systematic, unsystematic, and business risk.
Okay. Business risks are the risks that any business of the organization are being faced. Your market goes down, your product become obsolete, your processes become obsolete. If your processes are technology based, that you're not keeping up with your technology, you become obsolete. These are all business related risks. Whereas I have explained systematic risk, whereas the third component is unsystematic risk. That is the isolated risk where you can identify a particular piece of risk in its unique features. These are unsystematic risks. For example, you get a virus attack on your IT systems. This is unsystematic risk and this uniquely identifiable risk.
Okay, thank you. Usman Khan is saying, and I'm rephrasing the question a bit. He's saying, can audit risk be merged with business risk in versatile environment?
Audit risk, see, Usman, audit risk is the inability to detect certain material elements, material non-compliances, material breaches that audit is not capable to identify, detect in a timely manner. This is the audit risk. But the business risk is quite different. Like management is there, management is sitting who is looking into the future, they are foreseeing it. But internal audit can play a role to finger point to a certain risk that internal audit is feeling that the entire management is not looking to a particular piece of risk. And they can add value by through their early warning systems, early warning signs that this risk may materialize in future. Please do something about it to manage it.
Muhammad Ali Arshad has asked a very interesting question. We call it bullying at ACCA. But the question is how an internal auditor stay independent when his appointment / increments / bonuses are decided by HR. In some situations, when when an auditor asks something from HR regarding their hierarchy of approval, regarding staff loans, etc., they respond to it by saying, "Come to the head office and get it directly from us." That's beautiful as bullying. So that's
the core beauty of it. That's the core beauty of it. As long as financial industry is concerned, it is now being regulated, now being rightly aligned with these strategies. The guidelines categorically say that you have to report your annual KPIs have to be set by the board. Now they are actually micromanaging all those areas or avenues, which generally the new entrant in the internal audit industry seems that we cannot really operate independently because our administrative reporting is to the business lines. In administrative reporting, everything comes. Your annual increments, your bonuses, your travel approval, X, Y, Z. But now things are changed, and it's largely depends on the culture of the organization. If the culture of the organization, if you're lucky enough that you're getting into an organization which is risk aware organization and the compliance aware organization, you will not face such situations. And there are certainly certain organizations which are differently managed. You cannot do anything. You have to live with
it. Okay, just a couple more questions. We'll try to call it a day now because we've gone seriously over time.
I'm getting calls from my office as well.
Oh my God! All right, all right. So I think one last question, and that should be the most interesting question again. All right, this one. Adil Arshad is saying, is internal audit facilitate the management in the process of, does internal audit facilitate the management in the process of identification of departments risk?
Yes, it does. It does. It has a very good role. It has a very respected role to help different departments to identify their risks, to help them to identify their risks. And this is the core value addition that internal audit is doing.
Okay, all right, okay. I think that's all. There are a few more questions left and quite a lot of comments also, but I think in the interest of time, we'll skip some of the questions. I think overall it was a very interesting session, a lot of detail, a lot of attention to detail from Khurram's side. I think Khurram needs a big round of applause, a big round of virtual applause from all of you. Thank you very much, Khurram, for taking time
Thank you,
out.
Thomas.
And yeah, fantastic. And once again, our apologies for the slight delay in starting the session, initiating the session. Just final round of announcements, and that is that our certificate of participation will hopefully I start issuing later today, and at the same time I'll share the updated presentation. Khurram, by the way, a lot of people were asking about your presentation with the speaker notes. So if you can share the final presentation with us, I'll put it up on Google Drive.
All right, sure.
Along with other documents that you committed to offer. So I'll just put all of them up and share the presentations and the recording with all of them. Thank you very much. Very, very interactive session, and thank you to all the participants taking time out and attending this session. Thank you very much once again, and good.